Fitch Ratings has put out its latest update on India's sovereign rating. The long-term foreign currency issuer default rating has been maintained at a BBB- with a stable outlook. In its release, Fitch Ratings said that India's rating balances a strong medium-term growth outlook with favorable external balances. But on the flip side, there's weak government finances which continue to constrain our ratings. Joining us to help us understand the Fitch view on India is Thomas Rookmaaker, Director at Fitch Ratings. He's joining us here on Bloomberg Quint. Thomas, thanks so much for joining us. Appreciate you taking the time. My first question is, just very basic as to whether the government finances and the debt levels continue to be the biggest constraint on India's rating. As you know, one of your peer rating agencies has moved us up in the last few months, but Fitch seems to believe that the finances, government finances, are still a problem.
Yes, we believe that the government's finances are the Achilles heel in the sovereign credit profile of India. If you look at the general government debt levels, they're currently very high. 69% of GDP is the general government debt at this moment. And we do expect debt to come down in the coming years. But not immediately. Next year, we also expect the debt level to be close to 69% of GDP. And if you compare that to other countries, the BBB category median, so that's the median of all the countries rated BBB- like India, BBB flat, or BBB plus, is 41% of GDP. So there's still quite a large gap.
Okay. Thomas, on the fiscal deficit side, though, I think, last year the slippage was explained away by saying that it was a year of structural change, particularly the implementation of the new indirect tax system. How much sort of, leeway does Fitch give India on the slippage on last year's fiscal deficit? Because I note that you talk about the fact that you're also worried that the 3% target, which had been set a while back, will not be met for some time now.
Yes, well, that has to do clearly also with how confident you can be about the general government debt level coming down. Now, with the FRBM Act in place, and the aim to reach the 3% of GDP deficit for the central government, that aim or that target has been kicked out again. If you look at the adoption of the FRBM committee recommendations and the focus on bringing down debt in the longer run, so the debt ceiling of 60% for the general government and 40% for the central government, that's actually a very positive development, but a lot of it also depends on implementation. So the question becomes, okay, how confident are we that this debt level is going to come down substantially to this level of the ceiling?
So essentially, you're saying you'd want to see debt levels start to come down before, at least that weight on the rating goes away?
Well, it has to do with confidence that this debt level is coming down, It's all about implementation in the end. The track record of the governments since 2008 of implementing the FRBM Act is not great, as we all know. And you can't cross the sea merely by standing and staring at the water, as Rabindranath Tagore once said. You have to do things as well. It's about implementation.
All right, that's a nice way to put it, Thomas. Let me just ask you for your view on, the GST and whether you see that as something that could materially change the government's finances by pushing up the tax to GDP ratio. Again, are you convinced it'll happen, or do you still want to see proof of the tax base widening before you give some credit to that reform?
Well, first of all, credit to that reform. It's an important reform, especially when it comes to the trade part of it. So the transaction costs involved, which are now less. In terms of the revenue intake, you can be quite optimistic in the sense that, well, there's more compliance to be expected. as a result of the GST implementation. Although in our own forecasts, we haven't increased the revenue intake substantially, just only gradually. But it's an upside risk. That's the way we approach it. An upside risk to the revenues.
Okay. A more near-term downside risk to government finances, but also more importantly to the current account, could emerge from the way oil prices have moved, Thomas. I know that you take a more medium-term view, but there's no denying that 4 years of calm that the Indian economy had on account of moderate oil prices could be challenged now.
Yes. Of course, there's the fiscal question. So, then the question becomes, okay, what's this government going to do? To give them credit, in the past couple of years, they've liberalized the administrative fuel prices quite a bit. So in that sense, they won't be hit as hard as others, but it also depends on the policies going forward. What are they going to do with the excise tax, for instance? Looking at the oil prices, I think it's especially interesting to see how the current account is going to look like in the years ahead. So we have a widening of the current account already without a presumption of oil prices to stay where they are right now. And the current account is now, our FDI has fallen as well, net FDI, and is now no longer sufficient to cover the current account deficit. So the basic balance, which is the current account balance plus the net FDI inflows, is turning to a deficit, and makes the external finances of India a little bit weaker. India's external finances are still strong compared with peers. The reserve buffers are strong. So reserve buffers currently of 8.3 months of current account payments. So that relates to 7.0 months for the peer median. So still strong, but the oil prices are going or could have an impact on the external front as well.
Right. On the domestic economy, Thomas, what is your view on both growth and inflation? I note that you're only expecting interest rate increases next year in the Indian economy.
Yes, that's correct. We expect growth to pick up to 7.3% this fiscal and 7.5% next fiscal. The early indications are already that this is happening. Inflation is a bit of an uncertain factor, so we expect inflation to be 4.9% at the end of this fiscal year, and it's a bit uncertain, not just because of the oil prices, which could have an impact, but also because of government measures like the minimum support price hike. It's uncertain what the impact is going to be on inflation, but it's an upside, mainly an upside risk, I would say. And in terms of monetary policy, we don't expect in our baseline a hike this calendar year, but we expect the RBI to start next year to hike. Having said that, with the upside risks there of higher oil prices and also an impact of the minimum support price hike, you could imagine the RBI to move earlier, especially since it's so important to them, to this still rather new Monetary Policy Committee, to build a strong track record, and that's exactly what they're doing now. So since their establishment and their first meeting, they haven't. We haven't seen inflation cross the range, the official target range. So inflation has been within the range.
Absolutely.
And we have to.
Sorry, Thomas, we lost your audio there for a minute, but I was just going to switch focus to what you think the impact of the banking sector problems is going to be on the economy and on growth in the economy. I know that you have put in a note saying that you don't think that the capital that has been put in will be adequate to restart lending because most of it will get used in the cleanup.
Yes, exactly. So that's going to be a very gradual process. The impact of the cleanup on growth. I mean, this cleanup starts, of course, with recognizing that bad debts are a problem. The government has done that and RBI quite some time ago, and they're now implementing the reforms and providing capital. But before you get the economy going, that might or get the impact on the economy that may take some time.
All right, Thomas, thanks so much for talking to us. Appreciate you taking the time to explain the Fitch view.
Okay.
That's Thomas Rookmaaker of Fitch Ratings.